Can I merge ZESH and WELL under one company? If ZESH Syndrome Berhad and WELL Syndrome Berhad merge and treated under one company, both companies will be treated as a single business source. The adjusted business loss of ZESH Syndrome Berhad manufacturing business amounted to 300,000 will be treated as part of WELL Syndrome Berhad gross income from marketing and distribution. As ZESH Syndrome Berhad incurred a significant unabsorbed loss amounting to 500,000, WELL Syndrome Berhad with an aggregate income of 1 million in the year assessment of 2019 should be merged into ZESH Syndrome Berhad to utilize the unabsorbed capital allowance amounting to 700,000 and the unabsorbed losses amounting to 500,000. In result, this can reduce the tax liability of ZESH Syndrome Berhad. If ZESH Syndrome Berhad and WELL Syndrome Berhad does not merge, this company will be treated as two separate business sources. ZESH Syndrome Berhad and WELL Syndrome Berhad may choose to be separate business sources, as both firms may use different equipment and labor to produce or sell biscuit wire. Therefore, if they wish to merge as a single business source, more costs will have to be incurred. Tax loss of ZESH Syndrome Berhad cannot be utilized within the companies because the capital allowance must be set off against the same type of business source, which is manufacturing. Since ZESH derives its unabsorbed capital allowance from manufacturing business, then the amount cannot be utilized to set off against income derived from WELL Syndrome Berhad distribution business. However, since ZESH suffered business loss in the current year, its capital allowance of 700,000 will be carried forward and can be set off in the next year assessment. The amount of unabsorbed losses can be deducted from the total income from all business sources, which are manufacturing and distribution business. However, the manufacturing business loss of 300,000 is a current year loss and is to be deducted against the aggregate income of the company. In conclusion, there is high possibility for the company to be merged and treated as a single business source. It is because ZESH Syndrome Berhad and WELL Syndrome Berhad are in food industry, where ZESH Syndrome Berhad will manufacture the biscuit wire and WELL will distribute the biscuit wire. This means distribution business of WELL that taken over by ZESH can be treated as a single business source. Both companies should be treated as a single source in order to utilize the unabsorbed capital allowance within the company.
Leasing or outright purchase of the asset. Please help me choose the best option and give reasons. Here is some knowledge about leasing and outright purchase. The main advantage of leasing business equipment is that it allows ZESH Syndrome Berhad to acquire assets with minimal initial expenditures and allows ZESH Syndrome Berhad to run higher quality equipment which will be less likely to require repair, especially when the cash is tight. In the case of acquisition through leasing, ZESH Syndrome Berhad is not entitled to claim capital allowances on the leased asset as the company is not the owner of the asset. While for the outright purchase, the most obvious advantage of buying business equipment is that ZESH Syndrome Berhad gains ownership of it and will have the lowest cost of acquisition because the company does not have to pay any interest and they can extend the depreciation schedule over when they prefer. In the case of acquisition through outright purchase, capital allowance claim will be based on the installment paid and not the qualifying expenditure of the asset. But I still don't know which one is the best. The most advantageous option for ZESH Syndrome Berhad to require the machine is through leasing, since it will help to minimize the tax liability of the company. Here is why. First, timing. The full amount of lease rental is given a revenue deduction in the year of incur, while the claim of capital allowances need to be spread to various years in accordance with the specific rate. Next, set off. If the business has a current year business loss, the leasing charges will increase the adjusted loss. The current year business loss would be allowed to shelter other income in the current year at the aggregate income level. Third, utilization. If the current year business loss cannot be utilized in the particular year at aggregate income level, the unabsorbed business losses can be carried forward to set off against any business income in the future year at the statutory income level.
Can you explain about the interest restriction between ZESH Syndrome Berhad financing institution and Profound Syndrome Berhad? Section 33 subsection 2, which provided that where a taxpayer has borrowed for the purpose of producing business income and has also lent or invest money, the deductibility of the interest paid on borrowed money will be restricted. Z Sdn Bhd incur to borrow money from financing institution for the purpose to earn interest income for the investment, while Profon Sdn Bhd is borrow the loan from Z Sdn Bhd to expand its business. Therefore, Profon Sdn Bhd will qualify for a tax deduction as the borrowing made from Z Sdn Bhd is directly for production, while the interest expense incurred by Z Sdn Bhd will not be deductible because the loan is for investment purpose in obtaining rental income. However, if the risk-return interest cannot be offset against the income of the related investment, the excess interest expense cannot be carried forward and it would be a permanent loss. Z Sdn Bhd receive interest income from Profon Sdn Bhd, which is 6% is lower than the interest expense incurred to pay to the financial institution, which is 10%. Hence, to ensure full deductibility of interest expense, Z Sdn Bhd should charge interest rate 10% or more in order to offset the interest expense suffered. If that's so, how to overcome the interest restriction problem? Firstly, Z Sdn Bhd need to review interest charge annually by looking at cheaper source of financing and dispose the investment that are not profitable to pay off the borrowing with high cost of fund. In this case, Z Sdn Bhd should charge the interest rate 10% or more to Profon Sdn Bhd so that it can be offset the interest market rate 10% charged by financial institution. Next, Z Sdn Bhd should make some arrangement for Profon Sdn Bhd to borrow directly from the financing institution so that Z Sdn Bhd will not incur interest expense for the borrowing made as for investment in Profon Sdn Bhd. Therefore, Profon Sdn Bhd will borrow the loan and incur interest charge directly from financial institution.
Now, would you help me with tax planning on disposal of fixed asset? If Z Sdn Bhd dispose the machines to its subsidiary, it will be generally subjected to the control sales provisions of the Income Tax Act 1967. Under these provisions, the machines would be deemed to have been transferred at the tax written down values of the transferor and hence no balancing charge or balancing allowance would arise on the transferor. However, Z Sdn Bhd would only entitled to claim annual allowance based on the original acquisition cost of the assets but restricted to the tax written down value of the assets transferred. However, if Z Sdn Bhd disposed the machine to an unrelated company, balancing adjustment arose, specifically balancing charge or balancing allowance as stipulated in Schedule 3 of the Income Tax Act 1967. The balancing charge arises when the disposal value is higher than the residual expenditure and this will increase the statutory business income. The balancing allowance arises when the disposal value is lower than the residual expenditure. Since Z Sdn Bhd expected that the machine will give rise to a huge loss of disposal on these assets have been a very low resale value. Thus, the balancing allowance arose. The balancing allowance would reduce the statutory income of the business. Therefore, Z should dispose the machines on the unrelated company because the company will enjoy balancing allowance and it will reduce the tax liability for Z Sdn Bhd. The lorry was disposed of within 2 years of acquisition. Therefore, the IRBM would claw back all the capital allowances claimed in previous years and treat it as a balancing charge in the year of disposal. As such, the statutory income of the business would increase because the balancing charge is added to the adjusted income of the business. Therefore, Z should dispose of the lorry when it reached the maximum year of disposal, which means the lorry should be disposed in the year of 2020 to avoid balancing charge. Now I get it. Thank you for your help.
How to compute group relief? In order to determine whether a claimant company and surrendering company are related and eligible for group relief, there must be at least 70% of paid-up capital of surrendering or claimant company is directly or indirectly owned by claimant or surrendering company, or surrendering and claimant company are directly or indirectly owned by another company to qualify as related companies. So, what is surrendering and claimant company? Well, claimant company is a company that is related to the surrendering company, while surrendering company is a company having an adjusted loss in the basis period of a year of assessment. By virtue to paragraph 44A, subsection 3, subsection C of Income Tax Act 1967, Wells and Yamaha is a claimant company which is related to surrendering company of Zach, Profound and Rainis and Yamaha. This table shows the relationship between surrendering companies and claimant companies. Well, Zach and Rainis and Yamaha are related companies because they are met 70% of a shareholding requirement. Zach and Rainy are eligible to claim group tax relief and surrender their loss to Wells and Yamaha. However, Well and Profound are not related companies since it does not meet 70% shareholding requirement. Also, Profound and Yamaha is not eligible to claim group tax relief and cannot surrender its loss to Wells and Yamaha because it is currently claiming investment tax allowance for year assessment 2019. The amount of current year loss to be surrendered to claimant company is restricted to 70% of its adjusted loss in the basis period for year of assessment. Any excess will carry forward to the following year assessment. This table shows the computation of claimant's company total income. The amount of approved donation of 100,000 ringgit does not exceed the amount restriction of 10% of aggregate income. Therefore, this donation can be fully claimed and deducted against aggregate income of 1 million ringgit to compute defined aggregate income of 900,000 ringgit. The amount of loss surrendered from Zach and Rainis and Yamaha is 630,000 ringgit in total will be less with defined aggregate income to compute total income. The total income of Wells and Yamaha is 270,000 ringgit. Zach, Rainy and Profound and Yamaha had suffered losses for that current year. Therefore, there will be no income and the total income will be nil. The amount of unabsorbed current year loss of Zach and Rainis and Yamaha are 300,000 and 600,000 respectively. These amounts are restricted to 70% of their business losses. The adjusted loss to be surrendered to Wells and Yamaha are 210,000 ringgit by Zach and 420,000 ringgit by Rainis and Yamaha. The excess of loss will be carried forward to the following year assessment to be deducted against aggregate income of the company for the next year assessment. Profound and Yamaha is not entitled for group tax relief since the company is currently claiming for investment tax allowance. Therefore, the current year loss of Profound and Yamaha amounted 200,000 ringgit cannot be surrendered to Wells and Yamaha. However, the loss can be carried forward to the following year assessment. Since Zach and Yamaha have a capital allowance amounted to 700,000 ringgit, this amount will be carried forward to be set off against its business income for the following year assessment. Next, the rental income of apartments to Zach's factory workers is one of the business sources. Therefore, it can be set off against the unabsorbed business losses from Zach manufacturing business but not the unabsorbed capital allowance.
The best method of acquiring gas in your neighborhood? Is it share acquisition or asset acquisition? Advantages and disadvantages, either share acquisition or asset acquisition, will rely on various factors, including first, the tax attributes, second, acquiring company, third, economic health, and fourth, commercial consideration. As a result, the best method of Zach Senior Berhad to acquire Jet Senior Berhad is by acquisition of shares. This is because through this method, Zach Senior Berhad able to control the company since they will acquire majority of the ordinary payout capital of Jet Senior Berhad. All assets, including tangible and intangible assets, all tax attributes such as unabsorbed capital allowance, tax liability, residual expenses, debtor, and the holding period of property will be included with Jet Senior Berhad. Furthermore, Jet Senior Berhad can also be subject to liabilities of Jet Senior Berhad. First, the return on investment that Jet Senior Berhad receive is single-tier dividend. They are not required to deduct the tax from dividends paid to shareholders. Second, unabsorbed capital allowance, where it is a same entity. As a result, capital allowance can be carried forward and absorbed against the business. Third, the unabsorbed losses of the same entity. Therefore, the unabsorbed losses can be carried forward and absorbed against all business income of the company. Fourth, the trade payable or debtors. The company can claim for provision of doubtful debt and bad debt written off by the company under the new shareholders.
Oh, now I finally understand. Thanks for the helpful advice.